I'm 20 years old and I never have to worry about money again, just because I learned how to day trade. And in this video, I'm going to be going through and teaching you my exact steps on how I became consistently profitable and how you can do exactly the same. Now, you've probably seen loads of different influencers and loads of different videos online of people that are trying to teach you how to trade. And let me tell you the truth, a lot of concepts that people are teaching in the past, supply and demand, trend lines, they just simply don't work anywhere near as good and they are now outdated. And guess what? If you don't have the right foundation underneath you, then you can spend years and years learning how to trade and have absolutely nothing to show for it. So in this video, I'm going to be showing you the exact steps that have took me from making $0 a month to making a stupid amount of money that you wouldn't believe, and I'm going to show you how to exactly do that. Here you'll have the full steps that you need to take and being able to practice so you can start to become extremely profitable. I'm going to be showing you the websites that you need to start trading. I'm going to be giving you the foundations of the concepts that you need to learn. I'm going to be teaching you about trading psychology, so I'm going to make sure you have that mastered. I'm then going to be teaching you about liquidity, another thing that is extremely important when it comes to day trading, and you must master this. Then I'm going to make sure you can identify the real concepts that you need to be trading, and of course I'm going to be showing you how to put it all together after I have taught you what you need. So let's get right into the video. Now, starting off from the very start, you're going to need TradingView. This is going to be where you're going to enter into the market, and most importantly where you're going to do your analysis. So let's jump straight into it. So when you open up tradingview.com, you have a page that looks like this. What you want to do is go to products and click super charts. Then right here you will get a chart that will look something like this. Now you might be wondering, why are my candles black and blue and yours are green and red? The first thing that you're going to want to do when you open up TradingView is right click, go to settings, go to symbols, and change the color of your charts. Now you might be wondering, Louis, why is this so important? When you are trading, you can make money when the market is going up just as much as when the market is going down. Now I'll explain this in a minute, but basically this is very important because as your charts are set to green and red, your brain is automatically going to think when you see red that means bad, which most people think. When the market is going down, most people think that you are going to lose money, but this is incorrect, and you can make just as much money when the market is going down to when the market is going up. So make sure you have that set on your chart. Now you might be wondering, what charts do I look at when I'm trading? Now there are a few different instruments that people like to trade, and I'm going to tell you the best instrument to trade. So at the top, as you can see, we have all stocks, funds, futures, forex, crypto, indices, bonds, economy, and options. And you might be wondering, how on earth do I choose what I want to trade? And guess what? I'm going to make it extremely simple for you. You've probably heard about Forex. This is what most people like to trade, but you should not be trading Forex. You've probably heard of stocks. Now, stocks is a great thing to invest in the long term, but not to day trade. Funds, stay away from that. Futures is what you want to be trading. Futures is the best market, it is the most consistent market, and it is the most fair market. Now you might be confused on what I mean by this. So I specifically trade Nasdaq, and the reason I trade Nasdaq over Forex, for example Euro USD or USD JPY, this is basically trading a currency against another currency. And you might be wondering, what is the problem with that? When you trade futures, there is zero spreads. When you trade Forex, there is a lot of spreads. Let's say that I wanted to enter into the market right here. If I entered a buy position, which means I'm longing the market, hoping the price is going up, the actual chart and the actual broker is going to enter me into the market around here. And this is called spreads. Whereas when you're trading futures, if the price action is right here and I'm entering into the market, my entry is going to be exactly where I clicked it, maybe with a tiny bit of spread, nothing that you will notice. Now this is one reason I trade futures over Forex or any other chart. Another reason is depending on what broker you use is the price action you see. Now you might be wondering, what do I mean? When you're trading futures, everybody is trading the exact same price action. It doesn't matter what chart you're using, it doesn't matter what broker you're using, me and you are going to be looking at the exact same price action. If you're trading Forex, depending on what broker you use, and all the brokers are listed on the right, you will see different price action. So what this leads to is manipulation in the market, and that's why you want to avoid trading with Forex. Now, of course, you can make money on Forex, and there is people out there who make money on Forex. I'm not sponsored by futures, I'm just trying to give you the best chance possible on becoming a profitable trader. So now let's talk about opening long positions or opening a short position. So what this means is you can buy into the market. So when you're buying into a position, that means that you are hoping price action will come up, meaning that you will make money when price action goes up, and then you can sell for profits. But what most people don't know is you can also make the same amount of money by shorting the market, which means that you make money when the price action goes down. So what you're basically doing is borrowing money when you enter into a short position, then buying it back at a cheaper price. And this means that you make money when the market goes down. Because remember, when you are trading, if somebody loses money, that means somebody else is making money. So to become profitable, you just need to be better than the other person. So now you understand how the markets move and where you can enter into the markets, opening short or long positions. Now later in the video, I'll be showing you how to actually execute your positions, but first I want to talk about the most important part about trading, your trading psychology. And after I talk about trading psychology, I'm going to start to talk about the concepts. But most importantly, the reason why I'm putting this towards the start of the video is because you can be the best trader in the world. But if you don't master trading psychology, you're going to make absolutely no money. Remember, I have taught thousands and thousands of people. There are over 38,000 members in my Discord, and there are multiple common mistakes that I see traders make over and over and over again. So what this has enabled me to do is to help most people out before they make the same mistake again. Now, a big thing that I've seen over the past is you don't have to be the best trader to make the most amount of money. Now, what I mean by that is, I know traders that spend hours and hours practicing on the charts. They have the best technical analogy that you can possibly imagine, but when it comes to trading, they make no money. And then on the other hand, I know traders that might not be so technical, but they are extremely disciplined and they are extremely focused when it comes to trading with risk management, that they make loads and loads and loads of money. So what you must remember is the trading psychology is the most important part about trading. You have to go into every single day trading not expecting to catch a trade. And if you get a trade, then you take a trade. The number one reason on why traders are unprofitable is because you are going into the market trying to make money every single day. And guess what? The best traders don't take trades every single day. I don't enter trades every single day. Yes, I enter trades most days, but I don't go into the market looking for trades to take, because that will ultimately lead to bad decisions. Another thing, you shouldn't start trading for the money. Now, yes, you've probably clicked on this video and you've seen trading videos in the past because you've seen people make millions and millions of dollars. And yes, you will make that much money. But if you go into trading chasing the amount of money that you want to make and putting a time limit on it, then you simply won't achieve your goals as quick as you want to. I'm not going to sit here and lie to you and say you're going to make $1 million in a few weeks, because that is not the reality. You need to sit down and you need to take time and learn how to trade properly. If you go into the markets not focused on the money and focused on the skill, the amount of money that you will make in the future is stupid. Now remember, I'm not just sitting here and saying this. I've been trading for 4 years now. I've been through exactly what you have been through, and I'm here to help. Another reason on why traders are unprofitable is risk management, but I'll be talking about this more later in the video after I explain to you the charts. Now, I could speak hours and hours on about trading psychology, but I've put the main points across to you. So now let's actually look at the charts and start to identify liquidity, because this is what you're going to need the most. Okay, so right here we are looking at the S&P 500, and before I teach you about liquidity, you need to know how a candle works, and it is pretty simple. Right here you have a bullish candle. Now there are two different types of candles you can get. You can get a bullish candle or you can get a bearish candle. So to the left we have a bullish candle. Now all a bullish candle is simply means that from when the candle opened to when the candle closed, the candle went upwards. And then a bearish candle is opening at the top and then the candle dropping and closing below where it opened, and that is a bearish candle. Now you might be wondering, I don't understand that, so let me show you. Right here we have the open of a candle. We know it's the open of the candle because the candle is a bullish candle. Remember at the start of the video, blue is bullish, black is bearish. Blue's going up, black is going down. So when we have a bullish candle, the open of the candle is always at the bottom, and this right here is the open. We know this is a bullish candle because it went up, and then the close is at the top of the candle. Now, you might be wondering, what is this black line right here? Now, this is called a wick. So every candle represents a different time frame. If you look at the top left of the screen, we have the daily, the 4 hour, all of these are different time frames. So whatever time frame I'm on, for example, right here, I'm on the daily time frame. This means that this candle right here represents 1 day. So at the start of the day, we'll get the open, and at the end of the day, we'll get a candle close. And then these wicks right here are where the price action has been during that time, but not closed below. Let's say that this candle started at 12 p.m. At 1 a.m., price action might have came to this point right here, but again, the price action and the candle does not close until 12 p.m. again. So the price might have went down during that, it might have came down, went into this range right here, but again, we've not closed there, so we just create this wick and then prices came shooting back up, and then price has eventually closed here. Then it's the exact same for the bearish candle except reversed. Right here is the candle open. We know that this is the candle open because it is at the top, and if the candle is bearish, then the close must be at the bottom of the candle. Again, let's say that this is a 1 hour candle and we're on the 1 hour time frame. The price action has opened here at 3 p.m, but maybe at 3:15 price started to go up, creates this wick, price then comes down, closes right here, and then that is why we have a bearish candle with a wick above. That is pretty straightforward, and I hope you understand this. So now that you understand what a candle is, we can start to talk about price action. Right here, this is price action. It doesn't look picture perfect like you have mostly seen before. I don't want to show you the fake price action where people show you it looks like this, because guess what? Price action does not look like that every day, and this right here is real price action. As you can see, we have highs and we have lows. Now, we need to be able to identify this for a reason called liquidity. Now, liquidity is the way that the price moves, and there is different types of liquidity, but you need to understand a tiny bit about the market structure. So when you are trading, price action likes to create some sort of structure, and that structure creates something called liquidity. Now, like I said, this is what real price action looks like, but before I give you examples on the live chart, I want you to be able to really understand what liquidity is. So let's say that this is price action right here, and we're going up. Remember, you don't want to use trend lines. Trend lines is irrelevant, and the way that you have been taught probably before and how most people have been taught is to look at a trend like this, and this means that we are going up and price is going to go up. Forget everything that you've been taught in the past about that. You just need liquidity and you need a daily bias. Now, starting with liquidity, we have swing highs and swing lows. Now, all a swing high is when we take the recent high, creating a new high. For example, let's imagine that you can't see the price action to the right here, and we just get this high. So right here, we've put in this high, then we've put in a higher low. Because we have this higher low, this is called sell side liquidity, and it is a swing low. This is a swing low currently because price action has not came below this point in the market. And then as you can see, we had this swing high, which is called buy side liquidity because it is at the top of price action. And now before I explain any further, all liquidity is simply where other people's stop losses are resting in the market, okay? Remember what I taught you earlier. When you make money in the markets, that means that somebody else is losing out on money in the markets. So what do you want to do? You want to target where other people's stop losses are resting so you can take their money. And that is exactly what liquidity is. So right here we have sell side liquidity, which means that stop losses are resting below this point. Just imagine loads of money are below this point right here. Now there are different draws on liquidity. You can have stringer draws on liquidity and you can have less stringer draws on liquidity. And right here, again, we have swing highs and swing lows. So every time we put in a high, that is a swing high. So for example, if we're looking right here, we've just put in a swing low and we have this swing high right here. Now this is buy side liquidity. Why is this buy side liquidity? Because other people's stop losses are resting in the market. And what that means is there's lots of stop losses resting here. So guess what? We're going to target these stop losses and use it as our take profit point. So let's say that we entered in the market right here for whatever reason. This tool shows us where we entered, where our stop loss is, and where our take profit is. Our take profit in this instance is going to be at buy side liquidity. Why? Because this is where people's stop losses is resting. You might be wondering, Louis, how do we know that the stop loss and that the buy side liquidity rests at swing highs in the market? Because I'm telling you it does. I've been trading for over 4 years. These swing highs is just an obvious point in the market, and this is where the newer traders and traders in general will put a stop loss and use it as their safety net, and this is what we are attacking. So buy side liquidity has not currently been swept because the price action has not came above this point yet. As soon as price action comes above this buy side liquidity, we have now swept that buy side liquidity and it is now irrelevant. Then guess what we just created? Sell side liquidity. So what price action could do is come down and take sell side liquidity, and then as you can see, we kind of have buy side liquidity and sell side liquidity that is always being created. Now just because we have buy side and sell side liquidity does not mean that is always going to get hit. For example, if we look to the left here, this is also a swing low in the market, and this is also sell side liquidity. So just because we have liquidity does not mean it's going to get swept 100% of the time. You need confluences and you need other trading strategies to be able to target the liquidity. You cannot just trade off liquidity by itself. So this is the most common draw on liquidity. Now what I'm going to show you is my favorite draw on liquidity, and that is called equal highs and equal lows. Now remember, when you're trading, price action is not always going to look picture perfect. But let's say you're looking at this right here, and imagine of course that these lines are candles. What will happen sometimes with price action is the price will come to the exact same point in the market more than once. And as soon as this happens, this creates buy side liquidity. Now, not only does this create buy side liquidity, this creates an extremely strong draw on buy side liquidity. So guess what? There are lots of people's stop losses resting right here, and there are more people's stop losses resting here than there was at the swing highs before. So this is going to be where we target if we were to enter into a trade. So let's say we entered into a long position right here, where we would target the buy side liquidity because they are equal highs. Now I'm giving you the very basics to liquidity, so make sure you're paying attention because this is the best information you will ever receive. And then you can also get equal lows, exact same thing if the price action comes to the same point in the market below and doesn't take it. Now you might be wondering, does it have to be the exact same? Yes, the price action literally has to be at the exact same point. It cannot be off by 1 tick or 1 point. I'm going to be showing you one more example on liquidity, and that is trendline liquidity. As I just told you, most people would use trend lines to enter into the market. So let's say we have a trend line that looks like this. Price has tapped once, twice, and 3 times. So what is price action now most likely going to do? Most people would say that price action is going to become up because we have tapped this trend line. So most people are longing. Now that they are entering into long positions, where is their stop loss? Their stop losses are below this trend line, and we call this trend line liquidity or a low resistance liquidity run, or a high resistance liquidity run. Now don't worry about that too much, you just need to know that it is trend line liquidity, and this is where lots of stop losses are resting in the market. So what are we going to do? We are going to target them. Okay, so now I've told you a bit about liquidity. If you're still a bit confused, I have a full video on liquidity, so at the end of the video you can watch that if you want a recap on liquidity. But this is just the basics, and we are going to be going on to the next problem that you need to solve. Okay, now I've taught you a bit about liquidity, so what I'm going to do is show you a live example on what I'm teaching you next, which is a fair value gap. Now, fair value gaps are the second most important concept that you need to learn, arguably as important as liquidity. Now, the reason for this is because fair value gaps are going to be combined with liquidity to enter into the market, so you need to make sure that you understand both just as much. Now remember, all a fair value gap is a 3 candle pattern formation where the first and the third candle don't touch, connect, or overlap whatsoever. So let me show you an example live in the chart. Right here, you're looking at a bearish fair value gap. As you can see, we count out 3 candles, 1, 2, 3. The third candle here and the first candle here don't touch, connect, or overlap. So that gap that we have from the first to the third candle is called the fair value gap. We know that this is a bearish fair value gap because the candle in the middle is bearish. I will give you an example of a bullish fair value gap in a minute. Now you might be wondering, what on earth is the point of a fair value gap? Now, a fair value gap, otherwise known as an imbalance, you might have heard it before as an imbalance, is simply something that price action is drawn to a lot. So what I mean by that is, we have a gap like this in the market. What price action will do most of the time is come and fill it. And then you might be wondering, okay, why do we care about that information? Now, what most people have been taught is that when price action comes back and taps into a fair value gap, price action should reject it and come down and carry on going into the direction that it was originally going to. And why, yes, this works. This is a reason why I'm so profitable, because I do something that most traders don't do, and that is wait for this bearish fair value gap to be disrespected. Now again, I don't want to jump too far ahead, I will explain this later in the video, but all I want you to do right now is make sure you understand what a fair value gap is. So remember, it is simply a 3 candle pattern formation where the first and the third candle don't touch, connect, or overlap. We know that this is a bearish fair value gap because the second candle right here is bearish. And guess what? If we're looking at a bullish candle, we have a bullish example right here. Now this is a bullish fair value gap. The reason this is a bullish fair value gap is because we have 3 candles. 1 candle, 2 candle, 3 candle. The first and the third candle don't touch, connect, or overlap whatsoever. So this right here is the gap from the first to the third, and this is a bullish fair value gap. We know this is a bullish fair value gap because there is a bullish candle as the second candle. A common misconception that people have is that they think because we have a bearish candle and then a bullish candle that this makes this a bearish fair value gap, or you need 3 candles all the same color. And both of these are incorrect. As long as the bullish candle in the middle is bullish, then it is a bullish fair value gap, and same for a bearish fair value gap. If the second candle is bearish, then the fair value gap is bearish. Okay, so now I have shown you the 2 main concepts. So guess what I'm now going to do? I'm going to show you how you can simply use these 2 concepts, fair value gaps and liquidity, put them into price action and use it to create a trading strategy. Now there is one thing that I haven't taught you about yet, and that is called context. Now all context means is putting these different trading strategies and different concepts into something that makes sense. For example, you see a fair value gap, price is respecting a fair value gap, so that is extra confluence and extra context. Or let's say we have sell side liquidity. For example, right here we have sell side liquidity. As you can see, it is a swing low in the market, what I taught you about earlier. So we get that swing low and we drag it to the right. As you can see that this swing low has perfectly been swept and taken out because we have a wick below it. So as soon as we have a wick below, remember what I said, that is now irrelevant. So we have swept sell side liquidity. So you might be wondering, Louis, what do I do with this information? We have swept sell side liquidity and we still have buy side liquidity in the market. So price action could easily be drawn to buy side liquidity. Now, how are we going to find an entry to target buy side liquidity, you might be wondering? Well, guess what? I've gave you the exact tools on what I trade with every single day. Yes, I add a bit more into what I trade, but I'm teaching you the basics so you can get a good understanding of the markets. And also you might be questioning, why aren't I teaching you my whole strategy? It would take me a lot longer than just this one video to teach my exact strategy. So if you do want to learn that, then a link is in my bio, you can follow that. I have also just opened up a one-on-one mentorship if you want to get privately taught by me. But for yourself, you'll see exactly what I'm teaching you works in the market, and this is a prime example of that. As I just told you, we have something called a bearish fair value gap. This is a bearish fair value gap because the first candle and the third candle right here don't touch, connect or overlap. You can see the first candle, the third candle, we have this gap. This is a bearish fair value gap. Now remember what I told you, price action likes to come and fill this fair value gap in the market, just because that is what fair value gaps are meant to do. It is an imbalance of where orders are resting in the market that have not been filled yet. So the way that you're going to use this is by waiting for a bullish candle close above a bearish fair value gap. Because guess what? Now that we have disrespected this bearish fair value gap, disrespected simply means by having a bullish candle close above a bearish fair value gap, price action is most likely going to come for buy side liquidity. So what you can do is enter into a long position and target the buy side liquidity. And your stop loss is if you get a candle close back below the inversion fair value gap, if you get a candle close back below this bearish fair value gap that you had marked out. If you want to learn more about how I use my stop loss, the links are in my bio. And then you might be wondering, yes Louis, your take profit is not even a one-to-one, why would you take this trade? You would move your stop loss to break even here and target the highs that is resting in the market there. This trading strategy has over an 80% win rate, okay? It works incredible amounts of time and it doesn't just work once. This is how the markets move. So if we carry on playing the price action, as you can see, we're in the same situation. We've came down, we've still swept the sell side liquidity. We have buy side liquidity, and as well as us having these bearish fair value gaps right here, we are also respecting higher time frame bullish fair value gaps. So if we check the 3-minute time frame, as you can see, we have a bullish fair value gap right here. Now remember, this is context, and this is what I was talking about earlier in the video. Context is the reason for and the reason to not enter into a trade. And because price action is respecting this higher time frame bullish fair value gap and it has not disrespected it, this tells me that price action might want to come up. But guess what? I can't just guess and randomly enter into the market. So what I do is I wait for a bullish candle close above a bearish fair value gap, because the markets aren't random and this is exactly how they move. Now we have this candle close above this bullish fair value gap, I will enter into a long position. Don't just take my word for this, go back, look at your own charts and watch this happen every single day. I'll enter into a long position here, I'm targeting buy side liquidity, what I just taught you. We have a swing high here, we also have a swing high right here. This is my 2 points of take profit. As you can see, a very nice risk to reward, and this is where I'll be targeting. And guess what? Price action shoots up straight to these points. This is a trade that I took live on my Discord. Every single day I trade live in front of hundreds and hundreds of people. What I'm teaching you now, I do it live to show you that it really works. And what I'm teaching you is the basics of it, but it is all you need to get your feet wet and get trading and get started to learn how to trade. Now I have taught you most things, but you might be wondering, Louis, how do I actually enter into the market? Now, the way that you're going to do that is make sure you are logged into an account. So if you're looking at TradingView, right here, you want to open up your trading panel. Now your trading panel shows you lots of different brokers. Now again, like I said earlier, in my opinion, you're going to want to make sure you are trading futures and trading a futures broker. Here are all the different options that you can trade directly through TradingView. So in my opinion, use one of these, then that means you can enter and exit all through TradingView. So for the example, I'm just going to log into paper trading. You can also use a paper trading account to practice trading so you are ready for a live account. That is always a smart option, so you're not just losing money when you're first learning how to trade. So when you're looking at the market and you want to enter into the market, there is two ways that you want to do this. You can either use market orders or you can use limit orders. The difference between a market order and a limit order is market executions instantly enter you into the market. So what you want to do, right click onto your chart, click settings and click instant order placement. Now what this will do is allow you to correctly market execute into the price action. So if you look at the top left, you'll see a sell button, which will enter you into short positions. Then you'll see a buy button, which enters you into long positions. So that will instantly enter you into the price action, exactly what we are at right now. And then you have something called limit orders. So if you click this plus sign right here, you will see something that says create a buy limit order for buys or for sells. Sells will set a limit order for short positions, which when hit will enter you into a short. So let's say you can go right here and click plus, and then it will say create a sell limit. I cannot show you right now because the markets are not open. I'm recording this on a weekend. So let's say you click create new order and you create a sell. It will look something like this, where as you can see, it will set a limit order, which means that when price action comes to this point, you'll be tagged into the market and then you'll be in the position. I personally don't like doing this, and I personally just like to click buy and sell. So that is going to be the end of this video right here. I hope you did enjoy. I'm just trying to set you along the right path to start to understand some simple concepts and show you how you can implement them to use them in your day trading strategy. If this video did help, make sure to comment and like. I'll be giving away something to somebody who comments and likes. Also subscribes to this channel. And remember, I have a full one-on-one private mentorship. If you really want to accelerate your learning and take it to the next level and be taught by me one-on-one fully in a video call, then the link is in my description. You can also get access to my trading course, and whilst you're here, make sure to join my completely free Discord with over 38,000 members. All the links are in the description. Make sure you subscribe, and if you like this content, let me know and I will keep it coming. I will see you on the next video.